Hello, ladies and gentlemen, and welcome back to another episode of Crazy Money. I am your host, Paul Ollinger, and I am happy that you are here today to share in this conversation with my guest, Spencer Jakab. Spencer is the editor of the Wall Street Journal's Heard on the Street column and the author of a fascinating new book called The Revolution That Wasn't: GameStop, Reddit, and the Fleecing of the Retail Investor. Here's what it's about in a nutshell. In January of 2021, a large group of small investors from the WallStreetBets group on Reddit, the lawless social network Reddit, they rallied around the stock of video game retailer GameStop, which they believe had been unfairly under attack by short-selling hedge fund Melvin Capital. The subsequent and totally unexpected rally in the stock made millions for several WallStreetBets members and crippled Melvin Capital, which was losing up to $1 billion per day during the worst of the crisis. Well, crisis for them, but it was a party for the WallStreetBets guy. On this week's episode, Spencer and I talk about the perfect storm of market, societal, and technological factors that catalyzed the GameStop phenomenon, why the Robinhood stock trading app, which played a major role in this whole scenario, why it was designed to function exactly like a sports gambling app. We talk about how the WallStreetBets and Robinhood investors, that's in quotations, by the way, investors. You could see me making the air quotes, by the way, if you were watching this on our YouTube channel, which is youtube.com/crazymoneypodcast. You should go there, watch all the past episodes, and subscribe so that you get all the subsequent episodes. How these investors, in quotes, differed from your boring old E-Trade or Schwab customers like me, the difference between investing and gambling, and lastly, what the profound loss of capital at Melvin Capital means for hedge fund managers in the future. That is, in addition to market-based factors, political factors, climate-based factors, these hedge fund managers also have to take into consideration the potential madness of crowds. It's a fascinating story. I know you're going to love it. Please enjoy this conversation with Spencer Jakab. Spencer Jakab, welcome to Crazy Money.
Hey, thanks for having me.
Spencer, let's start by getting a little philosophical. What is the difference between gambling and investing?
Okay, well, you often hear the stock market compared to a casino, and I usually don't like that comparison. A casino is a place where the more you go in, the higher the likelihood that you'll not just lose money, but lose all of your money. Eventually, you'll hit gambler's ruin and lose all your money. The stock market is a place that has created tremendous wealth, can create tremendous wealth in the future. So, the two are diametrically opposed. You can become the richest man on earth, and you can be broke in the other place. The difference, though, is kind of blurred in the case of speculative manias, because people are basically, it's like putting money on black or on red, where the odds are against you, where you know that people are caught up in something. And then there's two theories you might have, right? You might have the sort of the greater fool theory. You're pretty cynical about it. I understand that this is a bubble. I understand that this object that I'm attaching part of my savings to might not be worth what it is, but a lot of people are interested in it, and I'm going to be smart enough or lucky enough, and really luck is the operative word, to get out. I'm going to hop on and hop out. And a lot of the people who I spoke to for my book were cynical in that way, which is fine. I wouldn't recommend it, right? Because your odds are not that good. Your odds are about as good as sort of like at a horse race, right? I mean, you're putting your money onto something that you're pretty sure is not worth that amount of money, but you're just waiting for some chump to come around who's either making the same bet as you, or doesn't know what it's worth, and is kind of rushing in with his or her money, and so that to me is gambling. That's pretty close to a casino, where it's a pure game of chance, where the odds are not really with you, and you're sort of conning yourself into thinking that they are. And a lot of the same, and what I learned. I've been writing about markets for a long time. I worked in markets before that, and I learned a lot through this episode and reporting it, because I spoke with gambling experts, I spoke with social psychologists, and I spoke with people who were involved in it. And I understood a bit better, the sort of the psychology of one of these manias, because there are a lot of parallels between what goes on at a horse race or whatever. Your horse almost came in, the kind of the near miss effect, where, well, if I'd gotten into that stock a little earlier, if I'd gotten out a little earlier, or held on a bit longer, There are all these near misses. There are all these things that are intentionally today, unfortunately, built into the world of investing for small fry that very much resemble gambling and draw from the same playbook intentionally.
I remember, I've gone to Vegas a few times. I participated in the first .com run up, the first .com bubble. Everybody talked about how much money they made on Cisco last month, but very few people talk about how much money they lost at the blackjack table, or how they got creamed on the downside of a stock that once experienced very high highs. What's the psychology behind that?
So I'm going to modify that a little bit. Yeah, absolutely. Everybody talks about the money they made. When you speak to someone about the stock market, the person who just took a bath in some stock is not going to talk about it. The person who just made a killing, your neighbor at a barbecue or whatever, who just made a killing or at one time made a killing, is going to talk about it. So the likelihood of hearing about a success obviously is far greater, and it gives you the impression that speculation is more profitable than it is. Also, people misremember. I mean, it's been shown, and this is not a case of dishonesty. If you speak with people about how they did in the stock market, they say, "Well, what kind of return do you think you made in the last 10 years? What percent a year on average do you think you've made or lost?" Their guesses are not like just a little bit off; they're wildly off, and they're being sincere. So people sort of color the past in a more positive way, but in this case, and the crowd that got into the meme stocks was different again, because they were in many cases kind of nihilistic about it. They were showing off. They were it was like the jackass of finance, where they were, trying to do something really cool, and then something bad would happen to them, and they'd brag about that. And they called it loss porn. They call it loss porn on WallStreetBets, which is the forum where the meme stocks, phenomenon was born, really. And so that's different. Of course, you have people with small amounts of money to lose, but you also have people, I think, who sort of have this kind of hopeless attitude. They're not out there like people maybe during the .com boom necessarily, kind of projecting their wealth into the future and seeing themselves like driving a Lamborghini and having millions of dollars if this can only keep going. They're also, and that is what one of the very weird things about this story. They used the stock market as a weapon, a societal weapon, kind of a cudgel against people they didn't like very much. If they lost money in the process, some of them actually felt pretty good about it. It was like getting a battle wound or something, so that's unusual. That's something that I don't think you've ever really seen in investing. And so I hesitate to say this time is different. Those are the four most dangerous words in finance, but this time was a little bit different because of the kind of the attitude that people had going in. At least some of the people who were kind of the ringleaders in the meme stock squeeze. They're and then now that's morphed into kind of conspiracy theories and stuff like that. Where they think they're going to make a lot of money in kind of this future, mother of all short squeezes. We can go into that if you want to, or you could just Google MOASS. Don't spend too much time going down that rabbit hole. But yeah, there's that is the thing I'm really surprised about, is more than a year and a half after sitting down to write this book, and 6 months after it came out, this thing is still going as strong as it was in the beginning. Not in exactly the same way, but I mean, there's a hard core of believers that this was just a preview of coming attractions.
Speculative manias are often and perhaps always a product of their time, and the one you write about, the meme stock phenomenon, is really could only have happened in 2019 or 2020 based on all the players that came together in this perfect storm. Let's talk about some of them. You mentioned WallStreetBets. Tell us about Reddit and WallStreetBets.
Sure. Well, Reddit and WallStreetBets. Reddit calls itself the front page of the internet. For all its popularity, it's not a very profitable web property. It's actually never has really made a profit because of its nature. You have different kinds of social media. You have social media where you have influencers and things like that, and people are basically contributing their content and it's being monetized. Reddit is not very good at monetizing content, but it has an algorithm that makes things popular. And in its case, it's the groups of people who congregate around a certain interest. And so there are today about 100,000 subreddits, different forums where people discuss things. And I like Reddit. I mean, there are things like you can go and talk about fly fishing or trail running, or people got information when they couldn't get through to state unemployment offices when the pandemic first hit, about how to apply for unemployment and how to get through when the lines are jammed. There's all kinds of useful stuff. I mean, there's a lot of, you got to be careful with health advice or financial advice or anything like that on the internet from a bunch of randos, but there's some good stuff there. But WallStreetBets was kind of a pretty marginal property until a few years before our story begins. And it was a place where people looked not just to make money, but to do it through hacks. So not like through, I'm going to buy this dividend paying stock and own it for 10 years. And this is why I think you should buy it, or this is why I disagree with you and you shouldn't buy it. It was, how do we kind of hack the system? How do we jump on something anomalous and weird that's happening right now? I don't really care why it's happening. Something out there happening. Or where do I go to show off this dumb thing I'm about to do, where I'm going to go take out a second mortgage on my house and put it all into deep out of the money call options on monkey.com, right? I mean, that's the kind of place it was. And as this young generation that really had no interest in finance, for reasons I can explain, a lot of things fell into place for this to happen, suddenly got very, very interested in the stock market, super interested. WallStreetBets was the main place. There was TikTok and there was YouTube and there was Facebook and there were Twitter influencers, but WallStreetBets was specifically the place where this revolution emerged from. And the algorithm that determines popularity is an algorithm in all those other places. It's something that computer scientists designed. On Reddit, the difference is that the algorithm is human designed. So it's like a more extreme algorithm, right? So let's say you and I both went onto WallStreetBets in 2019 or early 2020, when things were really kind of starting to go gangbusters. And you said something really sober. And you gave a long cerebral explanation of why you bought a stock.
Right.
And then I went in there, and I might be making it up, right? There's no way to know. I have like a pseudonym. I don't have I don't have followers, but I go on there and I say, hey, I took my kids' college savings and I took out a second mortgage and heavily margined, bought call options on this stock. YOLO, you only live once. I'm going to get a lot more attention because that's crazy, right? And so not only is it that I'm going to get more attention than you, but by the time a third person comes to the site, they're not going to see your cerebral take because it won't have gotten upvoted. And mine will get upvoted a lot and possibly rise to the top of the page. And people think like, what an idiot, or how cool, right? And so that's the place that you've heard about from your friends. That's the place where you go and learn about how to get in on the stock market thing, and you're 20 years old and have no idea what you're doing. You're going to see my crazy post and get the impression that this is what one does. And then when I make money doing it, because so many people have followed my lead, then you'll definitely pay attention to what I'm doing. And so that's kind of what was going on there. But you had several other things too.
Right.
You had a lot of things falling into place.
So the other big empowerment tool that they're using is not your father's E-Trade account, right? It's Robinhood, this app that grows in parallel with WallStreetBets. Tell us about Robinhood and what made it so appealing to this generation of traders.
Yeah, so Robinhood, even when our story begins, Robinhood was a pretty small stockbroker, except for the fact that in the 5 years preceding our story, about half of the brokerage accounts opened in the United States were opened with Robinhood. So how could those two things be true? How could half the accounts that are opened with a broker, be opened with this small broker, yet it's a kind of a small fry in terms of the amount of money that people have invested there, like a lot smaller than E-Trade and Ameritrade, Schwab, Fidelity, even Interactive Brokers and stuff like that. And the reason is that people had very small accounts. It appealed to people who were very, very new, who were just dabbling. And so the median account had something like $241 in it.
Sorry to interrupt. How much did it take to open a Robinhood account? $50, $100? What was the minimum?
You could open with $20. You could open it with pocket change.
Wow.
So in the past, I mean, let's go back. Let's take a trip down memory lane, not let's say even our memories, like our parents' memories. If you went to the 1940s or 1950s or 1960s, it would take a substantial amount of money before you could justify opening up a brokerage account, because just trading, making a single trade, and there were no index funds, right? And there were some mutual funds, but they were quite expensive. You might pay 7 or 8% just to get into a mutual fund. And then it was, there were high fees and whatever. So, you had to have a lot of money for brokers to help themselves to your money. They didn't really want to deal with mom and pop. It wasn't until really the kind of mid to late 1970s, when everything started to be deregulated and computers were invented, that discount brokerages, like, and Charles Schwab was the first one that came into their own, where like you might spend $50 and then later $30 to make a trade. It's still pretty expensive. You still couldn't do it with $20, obviously, because it was more than the commission was more than the amount of money you invested, but it was coming down. But what Robinhood, and they weren't the first ones to do it, but what they pioneered, they were the first ones to really make it profitable, was they offered you trades for zero, because that has become possible. It was started by two guys who were doing some back-end programming, had a business helping hedge funds trade on stock exchanges. And today's stock exchanges are just big computer banks and outside Kansas City and outside New York City, like in New Jersey near where I live. They're not, you think of the stock exchange, people running around in these funny coats. That's an anachronism. There are about 15 stock exchanges in the US, and there are a whole bunch of other kind of black boxes that kind of act like stock exchanges. And so it costs not nothing, but it costs very, very little. And so they're saying, these hedge funds pay almost nothing to make a trade. We could do this for people. And what they concentrated on first was building a really beautiful app. And they kept on testing it out on students and grad students near Stanford University, where they were based. And they made this super duper appealing app that in many ways resembles like FanDuel and DraftKings and things like that, which is very familiar to the younger generation. And I don't think it was by accident either. They won App of the Year when they launched it in 2015, and they already had 1 million people on their waiting list. So they took off like gangbusters. But then in late 2019, every other discount broker basically said, screw it. We can't compete with these guys. We're going to cut our commissions to zero. And they were worried. I mean, they make money in a lot of other ways. Charles Schwab, if you have an account at Charles Schwab, you probably have an account that's 100 times larger than the typical account at Robinhood, right? And you have a credit card, and you have an individual retirement account, or you have a 401k, or you took out a home line of credit or whatever, all kinds of other profitable stuff. So they didn't really care as much about the charging you $7 or $5 or whatever they charged you in late 2019 for a trade. And they were the first ones to say, screw it. If you can't beat them, join them. And everyone went to zero. But much to their surprise, trading exploded at every single discount broker, and Robinhood as well. So there was this frenzy of retail trading. You went from having about 10% of the trades across various stock exchanges to, by the time my story kind of hits its crescendo, more than 1/3 of trades. So you had a gigantic increase in individual interest in buying and selling individual stocks. And that was because it became free. And so there's this kind of poorly understood, but now it's better understood, theory in economics called the zero price effect. Is you can cut the price of something. The lower the price goes, maybe the more people want of it, but up to a certain point, right? If you could buy something kind of pretty mundane and utilitarian in your life that you really only need one of or two of, doesn't matter how cheap it gets, you're not gonna go out and buy a lot of them. But something that's fun, something like trading stocks, and trading stocks all of a sudden was really fun, especially for younger people. They'll use an unlimited amount of that service. And so you had this explosion in trading. But of course, it wasn't free, because Robinhood has to make money, and it doesn't sell people all these services. It does charge them some interest when it like lends them money on margin and stuff like that. But mainly it makes money by selling trades. And so it was very interested in getting its mostly young customers to trade as much as possible. The more they traded, the more money it made. And the more stupidly they traded, the more money it made, because it got paid more per trade, per options trade and stock trade than its competitors, even though those people had a lot more money. It got paid more per trade. And the reason was that the people who executed its trades, who were not stock exchanges, there are these like black boxes called market makers. They liked dealing with Robinhood's customers because they were very small. So they weren't going to move the stock a lot, until our story reaches its crescendo, when they moved it a lot. Like they made this few stocks the most traded securities in the world for a few days. But before that happened, they loved trading with Robinhood's customers because they had so little money, they didn't really move things. They were not very smart about the way they placed trades. They didn't place limit orders. They bought all kinds of high spread stocks where they could make more money, et cetera, et cetera. They were like the kind of peanut butter and jelly, Robinhood and these market makers. And
Right.
and so these young people were making some rich people on Wall Street much richer by engaging in all this trading. That's the kind of prelude to the story. And you had this explosion in sports gambling, which primed people for this kind of speculative activity through their smartphones. And then, as I said, you had social media and you had these financial influencers who kind of egged people on and got people very interested.
So summarize here. The Robinhood trader is young. They're very male. They have small balances. They trade like crazy. And Robinhood itself, the company, is doing everything it can to remove friction, that is, obstacles in between those young, impetuous men and the desire to trade and take action in their accounts, which is exactly what every financial advisor in the world will tell you don't want to be doing, right? And it also comes at a time, as you say, where there are people like Dave Portnoy from Barstool Sports and Chamath Palihapitiya, my former Facebook colleague, who are out there moving markets by going on TV and saying, buy this stock, buy that stock. So there are personalities that are kind of moving markets. Elon Musk, of course, out there. And then along comes the pandemic. So we've got these groups of small investors that are banded together on WallStreetBets, this platform that makes trading very, very easy. Oh, and by the way, just introduced options trading to people who shouldn't be trading options. And then the pandemic comes along. What kind of gasoline does that pour on the fire?
Huge gasoline. The pandemic really, like it you had this a lot of dry kindling there already. You had a lot of excitement, and then it was like just pouring nitroglycerin on it, right? I mean, and throwing a lit match. So you had this, just to describe the bear market that we had during the pandemic. You were at a record high for stocks in February 2020. You had the pandemic show up, everyone get locked down. We went in record time, but never nearly so quickly had we gone from record high to a bear market. Stocks fell by, S&P 500 fell by about 34%, peak to trough, very quickly. Then you had the most rapid ever, by an order of magnitude, recovery. So you had like face-ripping volatility. So if you're just in this for a game, if you're not, if you're me and I'll be 53 in a couple of months, and you have like 401k and stuff like that, it's pretty worrying for you. You just saw if you check your 401k statement, you got pretty bad news. If you're 24 years old and you don't really have any substantial savings in the stock market, as a matter of fact, you just opened an account, it's great. This is the most exciting game ever. This is like, a bunch of sports games going down to the wire. It's super duper exciting, and the opportunity to make money is there. And not only is the opportunity to make money there, but you had smart people like Warren Buffett, getting out of his airline stocks because, and he was wrong, but he could have been right? Maybe, you would have had 10 million people dead in the country and, no vaccines for 5 years or who knows what, right? I mean, you didn't know in March and April 2020. It was pretty prudent to him to get out of it, right? So, he got out of airlines. Then you had people saying, hey, buy airlines. And you had these airline stocks almost double within a period of a couple of months. And all kinds of other stocks go up too. And you had companies that were bankrupt, doubling in a day. Stuff people are saying, no, don't do that. It's bankrupt. That company has no worth. You shouldn't buy it. And then you're like, I bought it and I sold it the next day and I doubled my money. What are you talking about? It was why did you tell me not to buy that? I'm going to listen to this guy who's been trading for all of 2 months on Twitter or on
Right.
TikTok,
Yeah.
because clearly he knows what he's doing. And this Warren Buffett guy is like well past his prime. So you had people who kind of felt like geniuses. And just this has never happened before either. From the bottom of that bear market through to the year later, you had 96% of American stocks rise. So it was like shooting fish in a barrel. It was very difficult to pick a loser. And the dumbest stuff went up the most. You had like hydrogen garbage truck startups worth more than major truck manufacturers, companies that have never sold a single vehicle. Nikola that, was caught like basically pushing its trucks downhill to make it look like they could move. I mean, and stuff like that. And people poured their hard-earned savings into it. And they had new savings, by the way, because these young people often didn't have very much savings to put into the stock market. But because the pandemic hit, they had stimulus checks, they had enforced savings from not being able to go out, from maybe being unemployed and getting extra unemployment assistance or what have you. So not having things to spend money on and receiving, just kind of pennies from heaven from the government or what have you. And so, it was not a lot of money, but a lot of it was gambled away. It was a very tight correlation between when stimulus checks arrived and when people funded their accounts. And Robinhood, the way that they marketed their accounts wasn't through like TV. Like they had some TV commercials, but they were just feel-good TV commercials, not really sort of out there to drum up business. Their own customers drummed up business, because if you got someone to join, then they got a free stock, like a mystery stock. It was like a sweepstakes. Like it could be a $2 stock, but it just might be a $50 stock. So imagine putting $20 into an account, and then you get a $50 stock.
Right.
All of a sudden you have $70 on a $20 investment. So you're feeling pretty good. And then you go out and then if you find a friend to sign up, once you signed up, then you get another free stock. So they had like a 5-month payback period on this marketing spending.
So when does the Wall Street bet gang start to focus in on GameStop?
So GameStop was like a situation that really was created by hedge funds primarily with a lot of hubris. So it was very dangerous. Probably the worst year in history for selling stocks short was 2020. Because of all the stuff I just described. The dumbest stuff did the best. So the sort of things that you might naturally bet against, like, hey, this garbage truck doesn't work. They had a video of it rolling downhill. The kid doesn't even, they haven't sold a single one, and it's worth more than the biggest truck maker in the world. I'm going to bet against it. Oops, I just lost a ton of money betting against this thing because people rushed into it anyway. So the things that people felt safe betting against were companies that were total has-beens. And GameStop was going the way of Blockbuster Video. People were not really buying physical media in the video game world very much anymore. They were downloading things, right? It became digitized, or is becoming digitized. Hasn't yet completely. They were betting against AMC theaters that was months away from running out of money, and people were not really going to the movies in the middle of the pandemic. And even if they started to, it was going to run out of money. There was no saving it. So they bet against these surefire losers. But those trades became so crowded that people on WallStreetBets noticed that, hey, the thing with short interest is when you bet on a stock, the most you can make is infinity and the most you can lose is all your money. When you bet against a stock, that equation is reversed. You have unlimited losses. And so if there's a rapid, for whatever reason, rapid rise in the price of a stock, doesn't matter why it happened, you might start bleeding a lot of money very quickly and have to buy back the stock. So you don't own it. You sold it without owning it. You borrowed it to repay that loan. Otherwise, your losses will mount, as long as the stock keeps going up, and you might actually run out of money and be bankrupted. And so in the case of GameStop specifically, 140% of the available shares were shorted, which is possible. It's not illegal. It's a lot of misunderstanding about that. It is possible to do, but it's very reckless. And you only would really do it again with the surefire loser. And these hedge funds, it was a variety of different funds but there's one in particular that had that position on since 2014, a very successful hedge fund on Wall Street called Melvin Capital, that in a period of just a handful of days, on that and other stocks lost $7 billion. Since my book came out, it actually went out of business. But it lost $7 billion, needed an infusion of cash. $7 billion is a lot of money. And the amount of money lost collectively by short sellers on GameStop and the other meme stocks goes into the tens of billions of dollars. Short squeezes happen all the time, but they don't happen intentionally. And that's what really got my attention about this story, because I've been following markets for a long time, and it's illegal to do that. It would be illegal if you and I had a hedge fund and we saw someone doing that and we said, hey, let's all gang up on him in secret in some smoke-filled back room and buy a bunch of the stock all at once, and then buy a bunch of call options and stuff like that all at once, then we'll really have him over a barrel and make a ton of money. Well, you can't do that. That's stock manipulation. But what happened in this case probably wasn't illegal at all, because it happened out in the open. It was being discussed. You could go back several weeks and even a few months on WallStreetBets and see this being discussed and see people telling them the best way to do it. And clearly, there were some savvy people there, because they were telling them where they could get the most bang for the buck and how they could ambush these hedge funds.
Okay, so just to clarify, a hedge fund sees a stock that's weak or a business that's weak, right? They say that GameStop is fundamentally flawed like Blockbuster Video. It is part of the past, not of the future. Their fundamentals are terrible. They're going to go out of business. The stock is worth nothing. They make a bet by borrowing massive numbers of shares, which they will have to pay back in the future. Their bet is that that stock price will go way down, so that buying them back will be way cheaper than what they borrowed them for in the first place. To borrow them back, there has to be shares available. Sorry, to buy them back, there has to be shares to buy in the future. So the short squeeze, how does the short squeeze work, and what role does WallStreetBets play in that process?
So if you were to, and this didn't happen, but that's what they thought they were going to do. If you were to have something called a corner, which is an extreme version of a short squeeze, and it used to happen before there was an SEC. This happened on a regular basis. All the Vanderbilt and Gould and all these guys, this kind of Wall Street of yore, they would secretly, because there were no computers, you couldn't see them doing it, they would secretly buy up a whole bunch of stock, to the extent that if you were a short seller, it was not possible for you to buy back the stock that you owed. There's a kind of a classic quote by Daniel Drew, who's one of these old late 19th century speculators, who said, he who sells what isn't his and must buy it back or go to prison. And that's pretty much, true. I mean, you're bankrupt. You might have sold this stock at $10, but if I and my group control it all, we could say, well, what's it worth to you? What's all the money? Where's all the money you have? We'll sell it back to you for $1,000. You must return the stock. Otherwise, you're out of business. So, that's what they were attempting to do. They didn't quite get there, and that's because this group lacked cohesion. It was like there were some people who thought they were doing that, and they said they would never sell. And even today, who continue to own the stock, they think this short squeeze is going to happen, that it just hasn't happened, and they're phantom shares or all kinds of nonsense. But it came pretty close to happening, and even though it didn't happen, the stock went from, let's say, in the spring of it was less than a $2 stock in the spring of 2020, and it was worth at its peak $483. You've had stocks rise like that before, but you've never had it happen because people had organized online to make it happen. So that's the weird thing that I first noticed. So I said I've got to write about this, and then it became an international phenomenon really with the meme stocks. And then something else weird happened, which is that Robinhood almost went out of business, almost fried the system circuits and had to halt purchases.
Right, which seems very suspicious if you're part of the crowd that's trying to drive the stock up, and all of a sudden Robinhood halts trading in that one equity, and the guys on the other side of the trade apparently have the chance to at least take a step back, regroup, and so it looks like Robinhood is in the hands of the hedge fund, the dark black hedge fund industry.
Right.
What happens at that point?
Yeah, and just to say, hedge funds, this generation is distrustful of Wall Street. This is the Occupy Wall Street generation. Their formative experience were their parents or their parents' friends or whoever suffering during the financial crisis, maybe losing their homes, seeing their savings cut in half, what have you. So they and Wall Street was seen as the villain there. And so it's not that they had class resentment necessarily. There were rich people like Elon Musk who they thought were great, but people who put on a suit and go to an office on Wall Street, and then especially hedge funds, and then especially short sellers who always have been reviled. It seems like a nefarious thing to do, to bet that a stock will go down. Short selling hedge funds, they were enemy number one. And so hurting them was part of the appeal. It was like really a twofer for most of the people involved. And of course, they aren't a monolith. There are people who were out doing this just to make money, and there are people who are doing this just to hurt hedge funds. But there was a heavy overlap that wanted to do both. And for a while, they were doing both until Robinhood pulled the plug. I can explain to you the reason. You can read my book, and there's a whole chapter explaining why it happened. But it seems awfully suspicious because just as these hedge funds were totally on the ropes, and you had, basically it was a major international news story that GameStop was, that the tables had been turned on Wall Street. You had the main broker for this cohort say, sorry, actually, you're not allowed to buy this stock anymore. You could sell it, but you can't buy anymore. And they didn't do a very good job of explaining it, in part because they were about to go out of business. They needed to go out and raise a whole bunch of money. They didn't want to basically say, oh, hey, we're almost out of money. And, they needed to keep that part quiet for at least several hours. They later gave a pretty good explanation, and there have been reports about it, and the reasons are totally transparent. But it seems extremely suspicious. And the fund that lost the most money that I mentioned earlier, Melvin Capital, got a cash infusion from Citadel LLC. Citadel LLC is the sister company of Citadel Securities, which is the main processor of trades for Robinhood. So you can see that it also has the name Citadel, also has the same major shareholder, one of the richest men in America named Kenneth Griffin. And it seems like there are all these kind of overlapping interests, and the fix was in. And it was like, heads we win, tails you lose, and that was it was very easy to get that impression. And then you had several politicians stoking that. Maybe they didn't understand. I'd give them the benefit of the doubt, but you had politicians on the far left, the far right, and the middle. Basically, anybody who had any common sense, who wanted to comment on it, was siding with these populists, with these people who were trading these stocks, these young people. So, and then late night talk show hosts and everybody, and then congressional hearings were called that very day. So it seemed like a huge scandal. But the scandal really was that most of these young people lost money, and they were kind of goaded into gambling, and no one had done anything about that, and no one does anything about it today, because there's a very lucrative business of basically of just scalping, money from young, inexperienced investors who don't know how they should be investing their funds. And we started off in this conversation talking about a casino. They treat the stock market like a casino. If you treat it like one, then the house is going to, eventually walk away with your money, and not vice versa.
And the house in this case is Robinhood, right? I mean, which is ironically named.
The house is a lot of companies.
Okay.
Yeah. The house is Robinhood. The house is Citadel. The house is all the middlemen. So Wall Street is mainly not made of hedge funds that are betting big amounts of money. Wall Street is mainly made up of middlemen that like it when you show up. They're very happy you show up. When something like this happens, it's a very exciting time for Wall Street, because everyone's going to make money, with a few exceptions. I mean, Gabe Plotkin at Melvin Capital had a really bad month, in January 2021, and a few other people. But most hedge funds who were involved in this made money because, they're benefiting from the volatility, or they were just dumb luck being in the right place at the right time. And all the middlemen made a ton of money. They love it when there's a surge in volatility and a surge in trading activity. The investment banks had record quarters, Morgan Stanley and Goldman Sachs and all these people, because they all had businesses that touch this sort of thing. And they were just gushing about how much money they were making. And so, that if they're making a lot of money, then someone else is contributing a lot of money. And it's, it was the young retail trader primarily during this time. And yet they came away from it angry, not at the people who were sort of enabling their really, in some cases, it just really did descend into kind of pathological gambling. But but they were angry at the hedge funds who had shorted these stocks, and so it just sort of, it's this completely backwards, upside down world. And the hedge funds are not angels, but if you're out there shorting a stock, you're taking a very substantial risk because you did your research and you think something should go down. I mean, if you're a retail investor, hedge funds are kind of a pretty good part of the ecosystem to have, because the only thing that you can do as an investor, you can bet that a stock is going to go up and buy it, or you can abstain and not buy it. You can't. It's not very easy, and you really shouldn't bet that it's going to go down. It's something not something you should do yourself, and people generally don't do themselves because you can lose a ton of money very quickly. And so you have these professionals who see prices that they think are wrong, and they go in and they take the opposite bet and put some downward pressure on the stock. It makes it more likely that the price that you'll see when you show up at the stock market with very little experience is more correct. It makes it more likely that Enron will go out of business more quickly rather than more slowly, and stuff like that. Not just frauds, of course, but just, having them there is helpful. They're doing it in a self-interested way, but having people who can bet against stocks is helpful to you, the small investor.
But this isn't just about the fleecing of the small investor. Again, ironically, by one party, which is named after the mythical character who stole from the rich and gave to the poor. But it's also about the power of the small investor, right? As you write, that 1 million people with $1,000 each can do a lot of damage, and in a way certainly not anticipated by the people in the hedge fund world, right?
Yeah. And so we're in a new era because you have social media where things can go very viral very quickly. And you have people able to organize on social media. And so that's something that you never had before. Because as I said, you used to have it in the old days where very rich men, and, going back to an era when it was just men, it was just rich men. There were no poor people, involved in the stock market. And you'd have a handful of rich people gang up on another rich person, basically, in the stock market. There's just these games constantly being played. Today, of course, you have millions and millions of people in the stock market, and it's very difficult to do that. But all of a sudden, social media has made it possible for these kind of, I don't know, as a guy, Pete Atwater, who I spoke with in the book, who calls them flash mobs with money. They can make stocks go crazy. The problem is that you can't all make money. Like, if I say, like, hey, let's all buy this thing, and I get the ball rolling, and it turns into something that really builds a lot of momentum, Bed Bath & Beyond recently, stuff like that. Well, that's fine, but it might last a few hours, a few days, a few weeks. But eventually, something has to be worth what it's really worth. I mean, you run out of greater fools, and you don't have that many people who are late to the party anymore. And all of a sudden, the kind of the air comes out of the bubble, and so it makes retail investing really more dangerous and much more open to manipulation, because you don't know who these people are who get the ball rolling on social media. You have a lot of very smart people now. You have about 80 to 85% of hedge funds, by one estimate, that are monitoring social media in order to profit from it, or at least to kind of avoid being blindsided the next time, where, they have things that can read Reddit a lot faster than you can read. They can read 10,000 Reddit posts, before you've read one post, and use natural language processing to say, hey, this is a bot, this is not real, this might get going, and they might be the ones ultimately making the most money, not individuals. And people don't understand that. It's just like a boiler room pump and dump scheme in a way, except in this case, it's completely legal because they're not out there calling up people and saying, hey, you have to get in on this opportunity, kind of Wolf of Wall Street style. They see somebody, they see someone else getting it started and see what's going viral, and they hop on these things in a much more effective way than you can.
Robinhood put, as some have called them, financial weapons of mass destruction into the hands of just beyond children, to disastrous consequences at time. There was at least one Robinhood customer who thought he lost $700,000 and threw himself in front of a train. Have they moderated or have they modified their business practices at all?
Yeah, they say they have. So the weapons of financial weapons of mass destruction you refer to are options. Options are derivatives. they were not allowed generally to engage in, although this person did engage in the types of options trading that could wipe you out, where you would have a gigantic negative balance. They mainly transacted in the kinds of options that where you would pay a premium. You'd buy a contract to purchase or sell something in the future. And very often, Robinhood's customers would buy lottery ticket-like contracts, where they'd say, okay, the stock's at $20. I'm going to buy the right to buy the stock in a week for $20. Well, okay, I'll sell it to you for a penny because it's not going to be $20 in a week unless something really crazy happens. Of course, those crazy things did happen during the meme stock squeeze in 2020, and so some people did make money, but but the payoff was tremendous. If you paid 1 cent for something, you might make $5 or $10, right? You might make 50 or 100 times your money if things happen the right way. And you'd read about people doing that, and people did make fortunes like that during the meme stock squeeze. And so it became hugely appealing. The number of, especially of call options purchased, and also these financial weapons of mass destruction were used as kind of asymmetrical warfare tool during the meme stock squeeze. Because if you had $200, you could go out and buy GameStop or buy AMC or something and pile on to the amount of the kind of tsunami of money that was buying these stocks. But if you use that money instead and you bought out of the money call options, so call options, the very small chance of paying off, even if you were pretty sure you were not going to make money, you knew that you were putting pressure on them, because the options dealers, who gladly will write you a contract for the call option, once the share price starts to rise, they have to mechanically start buying the stock. So it's possible that you put down $10 or $50 and they wound up buying $500 or $1,000 worth of stock before your contract expired, just to hedge themselves because the stock started to rise. And so I have this chapter in the book. It sounds strange, but I mean it's called a gamma squeeze, and this was described in detail how to do it and why it worked on this message board. You did not have a lot of cerebral posts that went viral on this board, but this was one of them that did, where somebody said, hey, this is how you rig the system. This is a hack for the system, where you guys, with a bunch of you with a little bit of money, buy these kinds of options with this kind of maturity, this far out of the money. And, if the wind blows the right way, you can create a stampede with a very small amount of money.
Well, it's a really interesting story, Spencer, and I enjoyed learning a lot more about what I had read about tangentially in the news and getting under the hood with it. The name of the book is The Revolution That Wasn't: GameStop, Reddit, and the Fleecing of the Small Investor, by my guest, Spencer Jakab. Spencer, where can our listeners and viewers, nobody's reading here, not on the internet, where can they find out more about you?
Now, reading is old-fashioned. Well, you can read my tweets at my Twitter account, which is Spencer Jakab. That's SpencerJakab. You can look at spencerjakab.com, and you can read my articles and my colleagues' articles at the Wall Street Journal, where I'm the editor of the Heard on the Street column. Just Google Spencer Jakab and read what we write at Heard on the Street, which is the financial analysis and commentary section of the Wall Street Journal. Thanks for having me.
Do that. Don't join Robinhood and buy a bunch of call options. That'll do that in 20 years when you've learned something by reading Spencer's writing. So, Spencer, thanks a lot for your time. We'll put links to all that in the show notes. I greatly appreciate you joining us today.
Hey, thank you.
Hey, everybody, if you like what we're up to here at Crazy Money, do us and yourself a favor by following the show on your favorite podcast app and subscribing to our YouTube channel. Also, click the link in the show notes to subscribe to my new Substack, where you'll get bi-weekly thoughts on the role of money in our world and in our lives directly to your email inbox. Thanks for sticking around. We will see you next week.